One of the biggest risks of investing in individual stocks is lack of diversification. It can be very overwhelming to choose the right stock to get the best return on your investment. But what if there were a way to invest in great stocks without having to spend hours doing research? What if you could invest in multiple successful companies with just one share? Well, you can, and that's with an index fund. Index funds are one of the #1 investments for people on their financial independence journey. And in this video, we're going to let you know how the index fund works, what it is, and why it's one of our favorite investments. Stay tuned.
Hi guys, I'm Tessine.
And I'm John. Welcome to Millennial Fire, where we give you guys practical tips on reaching financial independence and early retirement. And if you've been enjoying our videos so far, please take a time to hit the like button because that really helps us out.
So what is an index fund? An index fund is a type of mutual fund, and a mutual fund is an investment that represents multiple stocks and bonds versus one individual stock. So in an individual stock investment, you could invest in Google, or you can look for an index fund that encompasses technology companies that include a portion of Google, Microsoft, Apple, and many other successful technology companies. So why is this video about index funds and not mutual funds? The answer to that question could take up a whole nother video, but to make a long story short, all mutual funds have something called expense ratios, which is the amount you pay in management fees in order to invest in that particular mutual fund. Index funds have astronomically lower expense ratios than other non-index mutual funds. Fidelity actually has an index fund that has an expense ratio of 0. Index funds have been researched and have proven that majority of the times they perform better than mutual funds that have higher expense ratios.
So why do we feel that index funds are such a great investment, not only for our financial independence journey, but also for yours? Well, I feel like the answer to that question can be summed up in 2 terms: diversification and simplicity. And I feel like I can best describe these terms with the hypothetical scenario. So let's imagine that I had the opportunity to invest directly in the NBA. My investment would pay me money when players perform well on the court, but inversely, if players couldn't perform on the court or they performed poorly, I would lose money. Option 1 in this investment is to invest in single players individually. So I do my research, I look at stats, I look at history, and I settle on the person that I feel like could do this job the best for me, and that's LeBron James. So I invest my money in LeBron James, and things are going well. LeBron is doing great, I'm getting paid, we're all happy. This is an example of investing in an individual stock. Option number 2 for investing in the NBA would be investing in a group of the top 10 players of the league. In this investment, it represents an index fund. We have the top 10 players, which you see also includes LeBron, so that means that my previous research was done well. But instead of my investment being with one player, I have it with 10 players. So you could say I can invest in 10 individual players too. This is where simplicity comes in. If I wanted to invest in 10 individual players, I would have to go and do the research and get the history of all of those players and bet on their success for the future on my own. With investing in this index fund, I invested in 10 players that are at the top of the league based on the criteria of the index, and I don't even know some of their names. So this is where the simplicity portion really comes in and really helps. Instead of spending my time looking at all of the individual players and how they've performed, I look at the overall bucket, the index fund itself, to see how it's performed over history and how good it is at choosing the top 10 players. So we're moving forward, and both of these investments are doing great. LeBron is doing great in the game. I'm getting paid there, but I'm also getting paid in my index fund because all 10 of those players are doing great as well. So the unthinkable happens at some point, and LeBron gets hurt. At this point, my investment in LeBron is now losing money. Why? Because remember, we're getting paid based on the performance of the player on the court. LeBron is hurt, so he can't play, he can't be on the court. So now that investment is losing money. But if we look at the index fund side of things, even though LeBron is hurt, we still have 9 other players to continue building my investment for me and continue building stats on the court. So with that, that means that even though LeBron is hurt, I could still be making money. I may not be making as much money because I lost a great player, but I could still be making money. And this is a part of diversification as well. I'm invested in 10 different players versus being invested in one. So when something goes wrong with the one, my funds aren't hurt as much. The next really cool thing about index funds is this. So now we see that LeBron is hurt. By this index fund's guidelines, he is no longer one of the top 10 players. So what this index fund will do for me is switch LeBron James out with the next player in line who used to be number 11 but is now number 10. And now my index fund has been reallocated and I can make the most money possible off of the top 10 players.
So how do you make money from index funds? 2 ways. Either you can invest in an index fund that offers a dividend, which is the fund's reward for you investing your money into their fund. And this is something that can be paid out monthly, it can be paid out quarterly, but it is a guaranteed reward for you investing your money in their fund. Another way to make money with an index fund is to sell at a higher price than you bought it for. It's always a goal in investing to buy low and sell high. Now we're going to walk you through how to set up your own Fidelity account and get started investing in index funds today. Stay tuned. We're on fidelity.com right now, and I want to point out the section right here, news and research. So we're going to click on mutual funds because, as you guys remember, an index fund is a type of mutual fund. And so we're going to click see results to see all their different funds that they have, which is quite a bit. But we're only interested in index funds. So we're under the refine your search section, we're going to click index. And then we're also going to refine to only provide the Fidelity native index funds. And the reason we're doing this is because the expense ratio will be a lot lower for funds that originated in the brokerage that you're investing in. So on this page, you can see a lot of information about each index fund that they offer. I'm going to point out expense ratios. After we've done that, we're going to go back to the main page and we're going to create an account. So you're going to click on the open an account link. And as you can see, they offer retirement, IRAs, investment, and savings accounts as well. For the purposes of this video, we're going to do non-retirement, non-tax advantage account. We're going to open up just a regular brokerage account. So we're going to click the open now button. And this part, they're just going to ask you to fill in all of your information. If you're not a customer already, you'll say no, and then they'll ask you for your name and you'll fill all that information out and you'll be all signed up. So we're logged in now, and the next thing that we want to do is to link a bank account. So we're going to go up here to accounts and trade, and we're going to go down to transfer, and you're going to click into your Fidelity accounts because that's where you want your money to go. And then down here, there's an option to link a new bank account. And then follow the prompts to get your bank account set up. So now that we have our account set up and our bank account linked, we're going to now make a trade. So we're going to go back up to the section that says account and trade. We're already logged in, and we're going to go down to trade. So it's going to show up your Fidelity account. So you're going to click go. And when you get to this page, you're going to switch over to mutual funds because, again, we're interested in index funds, which are a type of mutual fund. It automatically has it clicked on buy a mutual fund. So we're just going to click continue. FCROX is one of the index funds that Fidelity offers that has 0 expense ratios. So that's the one that we're going to invest in today. As you can see, it pulls up all the information about the stock here. And if you wanted to do more research before actually making your purchase, there's a little button here that says research. So you could click that as well. And I want to point out right here the NAV, which is the net asset value. If we wanted to buy a share of this index fund, it would be $9.70. Index funds don't operate the way that individual stocks do. Individual stocks can go up and down multiple times during the day, and whatever time you buy it out at, that's the price that you buy it for. With index funds, they have a net asset value that is only calculated once a day, and that is at the close of the market. The stock market hours are 9:30 to 4 p.m. Eastern Standard Time. So every day at 4 p.m., whatever the net asset value of each index fund is, that's how much investors would have paid for that index fund in that given date. So right now it's after 4 o'clock Eastern Standard Time. And so when we purchase a share or a portion of the share, we don't really know exactly how much it's going to be valued at until the close of market tomorrow. So where it says amount, we're going to type in $1 because you can invest with as little as $1. And then press preview order. And it says this purchase will be completed at the next available price, which will be the next net asset value, which will be calculated at market close tomorrow at 4 p.m. Eastern Standard Time. So we're going to place an order. And as you can see, we have an order confirmation, and now you know how to invest in index funds.
So I hope that by now you understand why we love index funds so much. If you have any questions, please don't hesitate to leave a comment below or reach out to us directly. And actually, one more thing we want to bring up. There's a book about index funds that we read that changed our entire perspective about investing in the stock market. It's called The Simple Path to Wealth. And we're actually offering this book to the first 100 people that watch this video here for free. So if you're interested in that, check it out. Read the book. It's an amazing book by J.L. Collins. But other than that, if you like this video, please like, subscribe, share with people that you think may also be interested, and happy investing. We look forward to seeing you next time.
See you guys.